Imagine a world where finance and technology fuse to create infinite possibilities. Welcome to the Titan Capital Management Podcast, where we explore the intersections of innovation and wealth creation. Today, my fellow Titans and I venture into crypto's digital frontier, uncover venture capital's power to reshape industries, and break down the strategies behind private wealth and small business success. Join us as we expand the horizons of financial thought and take you on a journey to tomorrow's economy.
So we're here with Top Down with TCM. My name is Evan Kassouf.
Daniel Cow.
Gary Lung.
Okay. You guys having a great day?
Absolutely. How are you?
I'm feeling good. Gary, I saw you walk in here. I feel like you're always on the phone. You're always doing some kind of call. You're always busy. How do you structure your day? Are you always doing 3 things at once? Are you always...
Not 3 things, maybe 10 things at once. No, but definitely need to structure my day very well. I use several apps to manage my time, including a new one that I started using recently. It was called Notion Calendar. And what I love about Notion is that it integrates across platforms like Gmail, Outlook, and it integrates multiple accounts into one easy-to-use calendar app. So it takes a lot of time management to be able to do everything that I've been doing lately.
Right.
And I can't say that it's easy. It's definitely very difficult. And one way that someone close to me described it, she said that it's like playing Tetris with your calendar. So it's a lot of Tetris with the calendar.
Okay.
Yeah.
So do you stress yourself out, or do you feel any kind of, you're an MBA student, you're doing TCM, you're doing 1,000 things, I always see you busy. How do you balance yourself,
That's a great question. I think the challenge is not to take on too much. And, that's easy to say, hard to do. I've definitely taken on more than I can chew. And I think the key is recognizing when that has happened and being conscious about how much mental energy I have to put in any particular activity and making a conscious decision to step back if it's the right thing to do. For example, about 2 weeks ago, I stepped away from my full-time employment so I can focus on my career pivot into venture capital. I can focus on school. And the reason I did that was because I recognized that although it was a very valuable experience that I was having, and although I was grateful for the position, I also recognized that there were certain priorities I wanted to accomplish with my life. And the ability for me to accomplish those priorities hinges on my ability to succeed in school and to make the value-added decisions in the right spaces I want to enter.
Right.
So life is tough, but it doesn't have to be. It's about making the right decisions.
Mm-hmm.
Yeah.
How do you feel, Daniel, about your days, your workload, being in school?
It definitely can be challenging. I think that there's a lot of optimism I see with it, though, because this is, an opportunity you won't be able to get again.
100%.
I think we talk a lot about how the most powerful thing we have as students is our title as students, right?
Yeah.
Kind of like how we've discussed previously, Gary mentions that as students, we have a certain margin of error, right? So I think it's really important that while you're a student, you can take advantages of the programs that schools offer in terms of networking, in terms of being able to connect with other students, like-minded students, is really important. I think that TCM, Smith, and all the other programs gives us a really great avenue to kind of assess our workload, but able to work through it with other students, because it's not often that you can meet so many like-minded individuals who are trying to accomplish the same thing.
It's amazing. That's my favorite part is you guys. We're able to connect and stuff. You feel like I'm part of a family immediately. As soon as I joined the program, I was with the Bond boys, and I'm like, wow, like all of us really enjoy what we're doing. We're actually present. It's a completely different experience. Because we're at Cal State Fullerton, and this is mostly a commuter school, so it's hard to connect. It's hard to find people who think like you, who want to do, anything related to investments, the market, anything. You have to go out of your way. But then you join this program, and it feels like we're here, Mm-hmm. We collaborate every day. We do cool projects. We work with each other. You know, it's a good thing. And school's, you know, you have to enjoy it while you can.
Exactly.
You know.
Absolutely. And just to touch on that a little bit, you brought up a good point that Cal State Fullerton is a commuter school. And I think that culture is especially true at the graduate level, where just about everyone's working a full-time job and they have family obligations. So they have to juggle school in addition to their kids, you know, being home
Right.
with their significant others, the work obligations, volunteer obligations out in the community. Here, you know, when we're in student life, you know, a lot of our volunteer opportunities are within the campus. But so for me, for instance, I volunteer with a sustainability consultancy, and we are everywhere. It requires some commuting in addition to the commuting for work. So it's definitely nice to have TCM as a venue or a forum where we can build strong connections in the industry we want to get into. We all want to enter finance in some way, shape, or form. So it's definitely a great opportunity to meet like-minded individuals who are along the same path. And the blessing of TCM is that we get in contact with people who are further along the way,
Right.
like we did during the student investment conference.
Right.
What a beautiful opportunity that was to meet career professionals or professionals who are further along in the career to give us guidance for earlier stage professionals. So I want to turn the question back on you, Evan.
Yeah.
How do you structure your days, and how are you enjoying your experience here with TCM and your work obligations? We know you're a busy man as well. You also work, so
Yeah.
tell us a little bit about your experience.
TCM really forced me to focus on structuring my day and not just going loose. I used to just wake up and just go for it, you know, whatever I could do. Maybe I'll go to the gym. Maybe I'll hang out with my buddies for a bit or something. Can't do that. You know, as soon as I joined TCM over the summer, I realized now I need to figure out and structure a day. I need to make, you know, plans. I need to figure out like what I'm going to do with my time, you know. And I think that's a good thing. That's a healthy step forward. I was sort of like just like loose. I would play it day by day, but now we get things set up. We get a lot done. So for me, I think I spent a lot of time sort of just making sure I'm on the right path, you know. No other good way to put it. But I work weekends. I'm in school 4 days, work the other 3 days. So, you know, but it's good. I feel great. I love it. I hang out at school. You know, you guys are my buddies, so I like it, you know. Yeah. So Daniel, I know you told me you like wealth management and stuff, and you want to eventually just work with your clients and not have to be with a firm or whatever. Like, what's your, you know, what do you want to
kind of like my
do?
goal?
Yeah.
Yeah, so I think when I was choosing my career, I think it's really important to have a forward-looking perspective. And I was kind of asking myself, once I found my passion for finance, what is going to stay in the next 15 to 20 to 25 years as I navigate all these career challenges? And the answer I came down to was people.
Yeah.
Right? I think that a lot of the things we do in TCM and a lot of the, you know, things like equity research, fixed income analysis, a lot of this, I wouldn't say is going to be completely eliminated in the future, but I think that there's going to be a lot of changes in the ways we value or the ways we view productivity. So what 5 or 10 analysts could accomplish, maybe it could be done by 1, maybe 2 managers overseeing a program or some type of proprietary software that a firm could have. But when you're a wealth manager or when you're working with clients, I think the most important thing isn't really just the performance or the data. It's about the relationship and the trust you build with them.
Yeah.
So joining TCM, part of my rationale was I want to be able to learn the research side, right? I want to be able to learn how to communicate these really in-depth topics into really simple terms. That's really what it is about meeting with clients, right? Clients aren't really, they don't really want to hear about DCF models and LBOs and 3 statements and EBIT, right? They want to hear about the return and they want to hear about updates to their portfolio. And most of the time that comes in very simple graphics and language that is not used by people in the industry. And what I kind of mean by that is that the focus for the future in terms of my career looks more so of having conversations with people rather than being stuck between data. And so I think it's really important that people in the field now kind of understand that to differentiate yourself, you're going to have to do something different than what 99% of other people are doing. And if you're going to be stuck in roles where there's a limited growth prospect, it's best to move out. And that's kind of why I chose wealth management.
That's a great point. That's a great point. You have to be moving around. You can't, just stick with the field because that's what you're doing. The world is changing fast, very fast. Within 3-4 years, we're going to see jobs disappear that have been here for hundreds.
Yeah, what I really appreciate about what you shared, Daniel, is the people-centric approach to finance.
Right.
I'm of the opinion that human beings are the last motes of humanity. And what I mean by that is that although certain activities such as number crunching and extrapolation might be able to be replaced by a program that uses machine learning and AI, what cannot really be replaced is the face-to-face human interaction that we have with one another. And I think as a wealth manager, and correct me if I'm wrong, Daniel, maybe you can provide more insight into this because you are definitely more well-researched in this area than I am. But what do you say, how much of the role of the wealth manager would you say is focused on relationship building and building trust and rapport?
In terms of what? In terms of instead of performance or what?
In terms of, say, if we were to divide the day of a wealth manager, how much of that day, how much of those working hours are spent building relationships, and how much of those working hours are spent doing data analysis or financial analysis?
I would say the split is closer to 90-10, 80-20. And the reason why I say this is because I think that with the invention of things like ETFs and the information that's being publicly available, a lot of the things that you're going to do as a wealth manager come down to talking to clients and being able to really delve in and build these comfort levels. Because the most important thing, or the most important thing a client can do is not just have these really good risk-adjusted returns, but it's to have a plan that they can follow, right? Because your risk tolerance and Evan's risk tolerance might be completely different. And if I can get you a 20% return and I can get you a 25% return, but you are apprehensive and you can't follow through with my suitable recommendations for your portfolio, then it's not going to mean much if you want to exit positions and that disrupts the strategy, because that may affect your long-term returns, right? Even if that's what we project. And Gary might end up having better returns despite the fact that you chose more equity-heavy portfolio, right?
Right.
So I think when it comes to clients, right, what you really have to do is be able to understand what the client wants and what is suitable for them, right? Because clients are never going to be able to invest in something that they don't have a lot of conviction in, right? A lot of clients, they don't actually take what is at face value, or they may overstate their risk tolerance too, which is another big point.
Right.
A client may say, hey, I really like equities, and with the first year you join them and their portfolio is up 25%, but then the next year there's a correction and their portfolio drops 8-10%, right? Because of whatever reason. And then they suddenly realize, oh, I'm actually not very risk averse.
They're worried every day.
Exactly.
They're calling
they're,
you.
They're
like,
checking
hey,
their
man, what's
portfolio
going on?
and they're constantly asking for updates, right? And as a wealth manager in the future, it's not going to be very sustainable if you have to constantly reassure clients just for a marginally better return, because in the industry, performance is not the end-all be-all for most clients, right? Of course, it's a huge part of where you can add value, but there's other sectors of wealth management and specifically financial planning where you can derive value, whether it's retirement planning, whether it's tax planning, whether it's estate planning. Advisors, I think, which is also a big misconception, is they're not just glorified portfolio managers, right, who sit behind a desk and reap all the rewards. There's a lot of ways that advisors can provide value adds that I think are a little more unconventional to what people typically think of when they see advisors. So I think that's why client relationships are really important, is because being able to go beyond the surface level and really build deep relationships is what really matters at the end of the day.
That's a great perspective. How about you, Evan? Where do you see yourself career-wise on the spectrum of the financial industry? And can you relate to anything that Daniel just shared?
I can for sure. I would say the more I talk to Daniel, actually, the more I like wealth management more than the traditional being a research analyst or anything like that. I like talking to people, and I feel like I can build relationships with clients, and I already kind of do that. Like I'm a server right now, and what I do is I'm trying to build a relationship with you within an hour, but enough so that you're enjoying your time and I'm enjoying my time with you. You know, so I think that's a good sort of experience to have. And I would say my end goal is to own my own business, whether it be a restaurant or some sort of maybe investment firm, something. But my older brother is a restaurant owner. He owns 3 coffee shops here in Orange County. And I actually had a question about that for you. But I see his process, and I see that he's able to hold on, let me turn my phone off. But my brother's a successful dude. He was able to sort of not go through the traditional school route. He's able to, work with good people, and now he has 3 coffee shops. And I look at him, and I want to start my own business. I see the steps that he went through. I see his successes. Not a lot of businesses make it. It's very hard, like if the consumer's not feeling good, or if we're in a recession, coffee shops, whatever it is, not going to do well at all. But I see his successes, and I know what to do now. So I'm going to follow his blueprint, and eventually I like working for myself, So I think doing TCM and being in the finance field, it's giving me more knowledge on investing. I always want to do my own personal investments. So all of this is beneficial. Being able to work with people, doing like team research, whatever, equity reports, it's all valuable. Everything is valuable, So, but eventually my end goal is to do my own thing. So, yeah.
I think that's a great answer. Okay, yeah, Gary, turning to you now, I had a question. How did you kind of get into VC, and what would it look like for someone trying to break in?
That's a great question. So I first developed an interest in VC through my mentor, Brandon Hoffman. He's the general partner of Sunset Ventures in LA. And I met Brandon through our university's executive and residence program. So something that is here at Cal State Fullerton that is an exceptional program that I recommend every junior, senior, and graduate student to participate in is the executive in residence program run through the College of Business and Economics. They pair earlier stage career professionals and students with people who are later on in the careers to provide guidance. Not just in their careers, but also in life. Yeah, it's a great opportunity. If you guys have the opportunity, you should also look into participating.
Is that how you met Brandon?
That is how I met Brandon,
Really?
yes.
Okay.
Yes. So prior to meeting Brandon, I had no idea what VC was. It was just something that you read about in the papers. I never took any kind of course or curriculum in my undergrad or here in grad school yet related to VC. So... And I also come from a small business operations background with some nonprofit consultancy experience. But something that I always wanted to do with my life was to make an impact and to develop our local economy. And I realized that the best way to do that might not be through the nonprofit route like I was pursuing in the past, but as I learned about VC, I learned that VC was all about channeling capital into founders. And then when those founders scale their businesses, they naturally create jobs in the local economy. And I thought, how cool is that? Mm-hmm. Right? So I started learning more and more. I started doing my own research and reading through online sources. And I came to discover some communities, started going to community events. I've had the privilege of attending some of the events that are run through Emerging LA. That is Brandon's community organization. And also learned about some venture scouting opportunities. So it was very much a learn by doing, and also learning by researching kind of experience. And I discovered that the more I dove into the community, the more I became familiar with not just the concepts, but also with the relationship dynamics that are involved. It seems like in VC, it's a very relationship focused industry, similar to wealth management. But on the VC side, it's almost like you're selling or you're building relationships on two different sides of the aisle. So for wealth management, it seems like it's very much a client relationship focus, whereas in the VC, it's not just building relationships with the clients, which are the limited partners, but also building relationships with startup founders. So in my stage of my entry into VC, I'm a venture scout for a funding partnership run by Level Up Ventures. And through it, I've learned the dynamics of between startups and VCs and how important it is to develop trust and develop strong relationships and develop a reputation in the field. Because really, it's the relationships that gets the VC access to
That's everything.
Exclusive deals. Yeah. So
I wanted to ask you from the business perspective. Let's say I have 3, 4, 5 locations. Just call it a coffee shop, right?
okay.
I have 3 or 4 or 5 coffee shops. I'm doing anywhere between 5 to 10 million in revenue a year. What factors do you look for you to say, okay, I want to help these guys scale? So if I go to you and I say, help me scale, what do you tell me? Do you want me to, how do you help me?
That's a great question. So you're coming from the perspective of a coffee shop owner. So are you coming to me as a venture capitalist, or are you coming to me as a angel investor? Because the perspectives are very different. In the venture capital field, there's very much a pressure to have these outsized returns from early investments, right? And the question to ask is this coffee shop scalable to the fact that it will return me 100x, sometimes 1,000x, and return my whole fund just from this one business alone? In VC, there's a concept called the power law, where very few companies reach unicorn status, and the rest are either mediocre companies or that don't take off at all, and they fail within a couple of years. And because of these pressures, economic pressures on the venture capitalists, the motivation is to look for those unicorns that fall in the power law curve, which looks like a hockey stick, in contrast to like a bell curve that you might see from other distributions. So for me, if I was the general partner of a VC firm and you came to me and you asked me, help me scale, one, I would ask, well, are you scalable? Do you have a product that would reach large distribution and adoption in this time frame that I've set out?
Right.
And if I gave you $100, would that $100 turn to $10,000? In I feel like for this time period,
like retail restaurants, it's probably way harder.
I think traditionally restaurants haven't been in that conversation.
Right.
I've seen consumer packaged goods be in some VC conversations. I haven't quite seen restaurants yet, but I'm not super well researched in that particular industry to really make a determination.
So I have a better one then. Let's say I'm Liquid Death, or let's say I come to you and I say I have the greatest drink you've ever had. It has 1,000 milligrams of caffeine, whatever it is. It's gonna knock your socks off, whatever. There's a million drinks. You go to the store, you can't decide which one. There's too many. So what do you ask me? Like, are you going to focus on brand reputation? Are you going to focus on what,
Okay. I see where you're coming from.
Something you could scale more. Yeah.
Yeah. So the scalability is just one factor of what I'd look at, right? I'd also look at your characteristics as a founder or as a business leader, the leader and manager, executive of this business. What is your pedigree as far as have you been able to scale a business before? And I ask these questions not to say, I will only invest in someone who has scaled a business before to
Right.
scale this business. But it's a matter of de-risking, right? Because so many businesses fail early on. I want to find the one that doesn't. And not only do I want to find the one that doesn't fail, I also want to find the one that will succeed and thrive and become massively successful, right? So a couple questions. One, have you scaled before? Two, what is your technical expertise and your background? Do you have a background in this company that you're trying to run? Recently, this has been in conversation in TCM. Brian Nichols took over Starbucks. What does this do for Starbucks?
Right.
Does Brian Nichols have the background and the pedigree to turn Starbucks around? And we see what he did at Chipotle.
Yeah.
We see what he did at Taco Bell. So I believe he was at Taco Bell, correct?
I'm not sure.
I'm not sure
Yeah,
either.
let's do a fact
I
check.
know he was
real
at
quick.
Chipotle, but-
Yeah, he was at Chipotle and did amazing things at
Yeah.
Chipotle. So
And the Starbucks shareholders really thought he's going to do a good job.
yeah,
So yeah.
he has a history of turning around companies that are in trouble. So that gives investors a positive sentiment or a de-risk sentiment that he would also be able to do the same thing at Starbucks. Did you find the fact?
He was the CEO at Taco Bell. You're
Oh,
correct.
he was at Taco Bell. Okay, very good. So same concept applies to a startup. Has this founder scaled companies before to an exit? So was he able to take the startup from point A to a point where he could cash out, or the company was sold to another company, or the company IPO'd, or does he have deep technical expertise in the product or some type of strategy of that startup so that we are confident, or we are confident that it won't fail, or that this startup will be able to reach the next point that we want it to reach. So there's factors related to the founder or the business leader. There's factors related to the product. An example I like to give is, is a company that makes a chip that is critical to the AI revolution, is that company as valuable or more valuable than the company that makes a device that, let's say, that goes on a moped, right? Completely different things. But I want to see how relevant and how attractive that company's product is for this particular market.
Right.
Is the company actually creating a product that people will buy? And if it doesn't create something that people will buy, is it creating something that people don't know they need yet, like with Apple when they came out with the iPhone, right?
Is there a level of convincing people that they need your help? Because let's say I have a great product and I'm doing fine by myself, but there's still people, maybe there's some hawks around, or is that sort of part of the game? Is you're trying to find like, hey man, I can really help you take it to the next level,
I think if I interpret your question correctly, is how useful is it, or how helpful is it for a investor to try to pressure a startup to receive their money?
Yeah.
I don't think that's ever helpful.
Okay.
Because I think the only thing that would accomplish is harm trust. There's a saying that no one likes to feel like they've been sold to, but everyone likes to feel like they bought something, right?
Got it. Yeah.
When someone buys something because there was a high pressure sales tactic, how does that person feel afterward? Is their buyer's remorse going to be greater or lower, right? So typically, VCs will invest if the investment opportunity is available. So the founder decides, you know what, I think I need some money right now to take me to the next stage. Then that's when they say, okay, I'm ready to accept investors. I'm ready to draft up this term sheet of how many shares or the type of investment vehicle I'm willing to issue at this time. Because startups don't just fund their operations with priced shares. They don't issue common stock and preferred stock right away. Sometimes they'll issue a promissory note. Like, hey, this is an agreement that when I am ready to issue shares, you will have this allocation of my shares, but I'm not ready to issue shares right now.
Right.
But I'll give you this note, and then please give me money for your note.
Yeah.
Something to that effect. It's called a SAFE, simple agreement for future equity.
Okay.
So typically, if the founder is ready to raise, then that's when the opportunity to invest becomes available. Otherwise, I don't know how successful a VC would be in pressuring founders to accept their money, and I don't know if that's a viable I'm pretty sure that wouldn't be a viable long-term strategy.
Right.
Yeah. I had kind of to change the pace, but if you guys could only invest in one thing, you have $100,000, you can only invest in one thing, but you have to hold on to it for the rest of your life. But it's only one thing, and you have to stick with it, you know? So 50, 60-year outlook.
You want to start with your own answer?
I'm going to start with you or Gary, because I don't know what I...
That's a great question.
It's
So
a hard question.
that's a very hard question because the risk tolerance changes over time. So what I would invest in today would be different than what 80-year-old Gary would
Yes.
invest in.
That's why your decision today is very important. It could be whatever. It doesn't have to be a stock. It can be, you know, buy a bunch of watches you think are going to be worth something, buy crypto, Pokemon cards.
Yeah.
It can be anything you want, a car.
So this is a crazy idea, but if this was available, it's not currently available, but if some company, a real estate company, bought land on Mars and was selling it for cheap on Earth.
You know, I think you can
You know?
do that. I think there's a website where they sell little plots of land. I'm sure it's not legit, but I remember this is like 5-6 years ago. I remember looking at this and they're selling acres. Maybe it's the moon.
I think it's the moon.
I think they're selling it on the moon. Yeah.
Yeah,
And
well,
we're going to the moon right now.
Well, the
so.
problem with that is I think under international law, no one's allowed to own any land on interstellar bodies. So, but if it was
Interstellar bodies?
if it was, or excuse me, interplanetary bodies, but if it was available, and I feel like human settlement on extraterrestrial bodies
Yeah.
is going to happen.
100%.
And if it was available, I'd like to be an early investor where I bought a plot of land
Yeah.
on Mars and charge rent to NASA for using my land.
That's actually
$100,000 though?
Yeah.
I don't know if you can get a piece.
You know,
Maybe a fractional
maybe
share?
maybe a fractional share.
Fractional share. Give you a 10 by 10 lot. When you go to Mars, you can just stand up, jump up and down, do some push-ups.
That's all you have, right?
Oh man, that's actually I didn't even think anything like that. What he said? Interplanetary body.
Interplanetary.
That was awesome.
Plots of land.
I actually, you're changing my answer now. I want to move up now, or now I want to invest in like the spaceship that takes you there or something.
SpaceX, baby.
Yeah, SpaceX gonna do or like Carnival Cruise will send you to the moon. Something like that. Maybe that's the future.
What a strategic pivot that would be if Carnival Cruise pivoted from maritime travel to space travel.
Space casinos,
Right?
right?
You heard it first on TCM, by the way.
Yeah.
So if you guys see Carnival offering space tours,
It was our idea. Yeah.
True.
It's probably going to happen. There's so many places the cruise ship can take you, but you can go wherever you want in the solar system. Going to Mars, going to Pluto. I'm telling you, that's next. Like you have water slides, casinos, riverboat casino. All right, so I'm gonna go. I would invest my money in the Carnival Cruise Line's spaceship. Carnival Cruise Line spaceship. Yeah.
If it's a company?
If it's a company, let's say I start it.
So what your investment? You said today, right? So
I invest in myself.
So you're going to be passively waiting your $100,000?
No, maybe I'm going to do it. I'm going to start the
So
first
that's your seed.
space riverboat casino company. Yeah. Yeah.
You know what? I'll invest in Gary's company. That's going to invest in that. I'll take fractional shares of whatever Gary's next big idea is.
you heard it first on TCM. Daniel Cow is going to be my first LP.
Yep. Actually, I'm changing my answer. Whatever Gary's doing, I'm investing in him.
Oh my gosh, you guys flatter me. Thank you.
Now you have 300,000, right?
Was that?
Now
Now we have 300,000.
Yeah.
We just started our first venture fund,
Pretty much.
$300,000 micro fund. Yeah, let's do this. So, on a realistic note, though, we don't have plots of land on Mars we can invest in. So we're going to take the time frame closer to our day and do an investable idea in today's market that's available to us publicly. So if I was to invest in a public security, I think I would put my money, and I had to hold on to it for the rest of my life.
Yeah.
I think I would put it in a index fund, to be honest. I mean, that's, for me, the safest investment with the best risk-adjusted returns over time. I don't know the specific percentage, but I believe in its history, the S&P returned on average 10.6% per year, correct? Is that the right number? So I think that would be the best play for me if I was to hold on to something until I'm 80.
That's the best, most realistic answer by
That is the
far.
most realistic answer.
I think what's great about the S&P 500 and those index funds is they naturally self-balance themselves. So companies that are underperforming or their business is not doing well in present day, they get dropped, and the next one comes right in. So you don't have to do anything at all.
Mm-hmm.
It truly is the best investment, and that kind of goes along with like the efficient market hypothesis. It's hard to generate alpha now. You know, is there really a way to? The S&P does it by itself. They self-balance. So, you know, I feel like it's hard to allocate your weightings and you know, beat the S&P. But that's the best answer. Yeah.
And there's also my answer. I also think that a lot of the large caps are priced very efficiently because there's so much publicly available information, where you can find a little bit more alpha in the small and mid cap, right? So, but the S&P does a lot of that work for you, right? I think the biggest part of the S&P is that it chooses its winners and it chooses its losers for you. There's no opportunity cost lost. You can spend your time elsewhere researching other securities or other forms of alternative investments that are a little more speculative that might have a higher return, which I think is more useful instead of trying to pick companies that have limited growth potential when the S&P already does that for you, where you have things where Gary does like VC or private equity or, you know, cryptocurrencies. You can spend more of your time there where these speculative assets have potential for higher long-term returns.
Yeah. Yeah.
You know, you brought up an interesting point, and you prompted me on this. A graphic that I found extremely interesting, very interesting, that Professor Kim shared with us in class was the Yale endowment, and how the investment profile, the portfolio has changed over time, where it was heavy in equities about 20, 30 years ago. It gradually diversified into private equity, hedge funds, venture capital, and commodities. And if we can pull that up, you know, that would be...
Pull it up, Jamie.
Pull it up.
Yale endowment.
But on the topic of generating alpha, does the portfolio manager or does the investor need to utilize alternatives in order to generate alpha in today's market?
I think 100%. I think 100%. They absolutely have to. It's impossible nowadays, you know. Depending on what you classify as alternatives, but there's lots of things you can do. What do we think, Daniel?
We'll put a picture up on the screen for the viewers, but it looks like there's 22% in VC, there's 8% in real estate, 3% in commodities, 15% in leveraged buyouts, 11% in foreign equities, only 2% in domestic equities, and then about 13% in cash and treasuries and fixed income. Wow. So a huge portion is not even in the U.S. stock market. What do you think about that, Gary? Sorry to cut you off.
No, I had nothing else.
That's a very interesting statistic. I think the alpha is in diversification. Diversification also de-risks, and at the same time, I think it offers an opportunity to generate the alpha that we're looking for. If everyone's investing, like we all just said, we're going to invest in the S&P 500 in an index fund, right? If everyone invests in the S&P 500 index fund, you know, everyone's doing the same thing, everyone's moving in the same line, no one's diverting or offering a contrarian view that would generate some kind of friction in the market that people would be able to capitalize on, right? But in these other markets and in these other investment vehicles, there's just so much opportunity because no one's investing in it.
Right.
100%.
Kind of going back to your original question, I think it depends a lot on your goals too. Because when we talk about generating alpha, I don't think that's necessarily the goal of everyone, right? Some people have different strategies, whether it's capital preservation or slow growth, value growth, right? So if you're talking to someone with a high risk tolerance, of course, I think it's valuable to invest in these alternative assets, and part of where my interest comes in too, right? But it does add diversification, but I wouldn't say it's a necessity to generate alpha. But part of my thesis as a wealth manager and trying to expose myself to these different fields of cryptocurrencies, venture capital, private equities, that I think that you are right in the sense that it is the future of people who do want these significantly abnormal returns that we've seen in the past 20 years, right? I forget the statistic. We can pull it up eventually, but I think 20 years ago, there was only a couple hundred private equity firms, right? Fast forward to 2024, there's 15,000. So that kind of shows you the explosion in alternative assets and the desire for investors to have these abnormal returns, right? For these risk-tolerant investors in the 1%. But for traditional investors, I don't think it's an absolute necessity. But for people seeking these larger returns over a long horizon, I think that there is more opportunity out there that is available. But Gary, my question to you now would be, how saturated do you think the venture capital market is now compared to 20 years ago? And do you think that there are going to be challenges in terms of more competition entering as we see it starts to emerge further and further in different markets outside of its primary markets, like the New Yorks of the world and other foreign markets?
That's a great question, and if I may ask, just so I can get a little bit of clarity on your question. When you say how saturated is the market for VC, are we talking about how saturated are the number of funds, how saturated are the startups that are seeking VC dollars, or how saturated are the number of LPs willing to invest in a VC firm? Can you please provide
I would go more towards the funds because I think that there's always going to be startups, right? There's constant innovation and there's always going to be chances to invest, but how many investors are out there that are actually going to be successful versus funds that just have shorter lifespans?
That's a great question. And I think the pattern for VC firms also follow a power law distribution. There has been an explosion in microfunds over the last 10 years. And microfunds are firms that manage anywhere less than $50 million. So there's been a large amount of firms entering the field. However, at the same time, they're fighting for the same amount of dollars, raising the same amount of dollars from like LPs and corporate venture and angel investors. A trend that we've seen over the last 2 quarters is there's a phrase in the industry where the investment trends are there's a flight towards quality, which means that LPs are more willing to invest in more established firms and established managers with track records than newer firms. And a lot of times this causes newer firms to have difficulty in raising new cash, in finding people who are willing to invest in them. So I would say it is saturated. And I need to do a little bit more research on this, but one of my colleagues in VC University mentioned that the returns for smaller funds are actually greater than the returns one might experience at a large fund. And that might have something to do with the quality of deals that emerging fund managers might have access to. The fund manager might have more access to people in their local community, et cetera. I'm not exactly sure on why that is, but I'll have to do more research on that to give you a clear answer. Yeah.
Thank you. That was a really good question. Evan, turning to you, you've always been interested in very speculative and diverse assets. What do you think is keen in researching these things, and how do you find value where others don't?
How do I find value where others don't? It's hard. I think from like a perspective of trading or investing or business, or what do you mean?
It's open-ended. Trading, investing, however you want to approach the question.
How do I find value where others don't? Honestly, I got started in like trading, investing by doing options. I started out in like the worst possible way to learn how to properly manage money, and my risk tolerance was, let's say, it was bad. It was all risk. But the reason I liked it was that it's the most inefficient market right now. Options, derivatives, it's not perfectly solved by algos yet. It kind of is, and there are hedge funds that just run like option algos to try and like buy and sell, and they're effectively market makers for individual stocks. And I think if you're able to understand like basic arbitrage concepts, like the option pricing model, you can make arbitrage money now, which is almost impossible in 2024. So, but I would say that's kind of how I got started, and I thought it was really interesting that if you could sort of project and like time the market in a certain way, you can make excess return you cannot find anywhere else. If I know, or if I don't know, if I think something might happen by a certain time frame, I can buy an option or do something that can make me what you would make in your whole life, 1,000% return, whatever. Obviously, there's a extreme risk that comes with that, but you don't take any risk, you don't get anything. So,
right.
Not sure if I answered your direct question, but
I think you did. I think you said you find value where others don't through arbitrage, and how there's still value in unconventional markets.
And unconventional markets, that was my answer.
Right.
And there are people who make a lot of money to set up trading algos and make sure that markets are perfectly efficient. You don't even need retail volume anymore. There are algos that are set up just to buy like lots at a time and bid up a price on no volume. So you'll see like stocks move constantly now. It used to be back in the day, like a stock wouldn't move for a few days, but there are algos that they're like against each other. So I don't know what the stat is, but almost like 67% of trading is computerized now. So the markets it's a completely different landscape than what it was before. But
Pull it up, Daniel.
Pull it up, Jamie. But I think that's what makes it hard. You have to do things that other people aren't willing to, and you have to use your finance skills, your knowledge. Like you could do like Pokemon cards is something else. I've been talking with my brother about that. There's actually a lot of money there with like grading cards and stuff like that. But I guess that's something I'm more interested in, is the alternative side of trying to, doing anything like that. But,
yeah, you're spot on. It's 60 to 75% of trading is all algorithmic or computerized now.
Yeah. So, what do you think, Gary?
I think it's very interesting. I've never touched options before, so this is a whole new world to me.
It's a black box. I call it the black box. Once you open it and once you see how much you can make, you can't go back. But
Close it.
it's options were designed to be hedging instruments first. If I own 1,000 shares of GE, options were designed for me to protect myself against a recession or something like that. But I would say now they're used more for speculation. Traditional managers use them for hedging, and that's what they're supposed to be. But where the retail volume comes from and where the arbitrage opportunity comes from is the speculation. So you'll see like options trade at premiums, right? If you're able to find a gap between premiums at certain levels, that's one of the last sort of realms of inefficiency left. So stuff like that really interests me. Yeah.
That was a great response. I think previously you wanted to discuss something called the engineer's dilemma.
Yeah.
Yes.
Do you want to talk about that?
Yeah. So the engineer's dilemma is, and I'm going to relate it back to a a corporate sense. But the engineer's dilemma is someone is paid to design and innovate a product, right? And at a certain level, let's say they start innovating by themselves. They're a, Einstein, something. You're in your own lab, you're doing your own thing. But someone who works for a company, they're forced to produce something maybe every year or every quarter. They have to up a design by a little bit. So there's this thing called the engineer's dilemma, but it can also just be like social construction of you're forcing these people who are supposed to be in their raw state innovators. They're trying to design something that no one has seen, like someone who sculpts a car, right? But instead, you're forcing them on a corporate level, hey, here's a deadline. I need a new product by the end of Q3 every year. That's kind of like Apple. They have to make a new phone, right? They have to do certain things. So if you're an engineer and you really have a great idea and you're putting all your love, all your passion into one thing, do you want to do that? Do you want to go all out? What are you going to do for the next time? So it feels like we've kind of devolved from, when Steve Jobs released the iPhone, that was a next step up the ladder. That's innovation, right? But has there been any innovation with Apple since then, aside from AirPods and stuff like that? So I feel like it's hard once you open that box to, the iPhone makes them their money. They can't stray away from that. Do they want to take the risk is kind of what I'm saying. Do you want to keep innovating if you know this is what's working, But is that slowing us down, right? Because we've been in kind of the same state. I think the only thing that's really been transformative in the last couple of years has been AI. They were able to bring that to the retail user like us. But AI has been around for a while. I forget what it was, like 70s, 80s, IBM or something like that. It's been around. But I would say that's kind of the engineer's dilemma. Yeah. So I think it brings a negative corporate culture is what I'm trying to say. When you're forcing these people to constantly pump out products, I don't think it's good for them. I don't think it's good for society. And it slows down true innovation, right? I don't know if you guys have noticed, but when you see cars on the road now, doesn't everything kind of look the same? There's less, everything is more curved, everything is round, everything is supposed to be appealing to a mass audience, right? But if you look at cars from the 80s and 90s, everything is blocky. It's in your face. It's almost like it almost really, you have to take a step back. If you look at like an old BMW or something, old Mercedes, they really catch your eye. Sometimes you might not even like it, right? But now everything is so streamlined towards the largest audience. I think we've got out of touch with really making art, really designing something, really, just taking anything to the next level. I think, if you're Toyota, why take the risk? If you look at a Prius now, it looks like a spaceship. It looks like there's obviously great engineers working on it, but there's no love to it, right? When I look at a 90s BMW, I go, that's a piece of art. Someone crafted this. Someone really sculpted that, right? Yeah. So
that's a really good point. And we see it across industries, not just in technical industries like software or hardware engineering or with automobiles. I think we see that pattern also in things like music. Pop music has sounded the same for the last however many years, for a decade, 15, 20 years. The only thing that's changed is really the flavor of the lyrics. But the beats are the same because, the engineers have discovered what works.
Yes.
What catches the ear, what causes that dopamine response, right? And they want to repeat it over and over and over again. Right. So the motivation isn't to innovate. They leave that to the artists, the true artists or whatnot.
Yeah.
Right? And I see your point where, we look at things like automobiles, the aesthetic of the automobile. I mean, I want to argue that there are iterations and there are changes that happen along the way. But how do we motivate people to really break out of the shell is the question, right? I think a great company going back to business, is a great company instills a culture where people have a learning mentality, that they don't become complacent in any one thing and say, oh, this is our bread and butter.
Right.
I think the moment that we have the idea that, oh, this is my bread and butter, we latch onto it, and we have a tendency to do what's comfortable.
Right.
Right. To sink into comfortability. But I think growth comes from friction, just like in the markets, right?
Correct.
Value is found when we see those areas where there's a misalignment between the knowledge or the information that's available and what people are willing to invest in. If it's easy to invest in something and this is a safe route, the returns aren't as great, right? The risk return principle. So great returns, like in the markets and in business like in the markets, comes from doing what's not comfortable.
Right.
There's a great book by Shunryu Suzuki. It's a Zen Buddhist book, actually, that you guys know who Phil Jackson is?
Of course.
Okay, so Phil Jackson made all of the Lakers read it. It's called Zen Mind, Beginner's Mind. And in the book, he says, for the expert, there's only one solution, but for the beginner, there's many.
Make sure you're talking to the mic.
Oh,
Gets the audio better like this,
Oh, okay,
this, like your karaoke, karaoke. You know,
yeah, I hear you.
that's cool.
Yeah.
I think, to kind of build off what Gary said and what your original question was, the engineer's dilemma. I think that as time has progressed, more so companies have favored productivity and efficiency over artistic values. So we see that there's more simplistic designs with how we develop architecture, with how we develop auto manufacturing, with our phones. And every facet of everything we do is more about efficiency than it is about design. And I think that's an inherent flaw because as we continue to quote-unquote evolve, I think we are actually it's kind of like inverse. We're like going back to more primitive states, right? So I think that in the next 15, 20, 25, however long it takes, there should be some type of reversal, because I think the problem is that while companies produce these simplistic designs, it's also been on the consumer to be complacent and to kind of reject this form of what's it called? Minimalistic modernism. Where you kind of lose your eye for appeal, right? But also on Gary's point of friction, I think that one of the things that we don't talk about enough is how lazy or how unwilling to change the consumer is. A lot of the companies we see, their innovations really rely on doing what main thing is reducing friction, right? So the reason why companies like DoorDash and Uber and Apple have been so successful in the past 20 years is that they're reducing the amount of steps it takes and adding convenience to where there isn't a need for picking up the phone, calling, ordering from all of these various restaurants, but instead you just click a few buttons on the app, you have no face-to-face interactions, and you get food at your door within 15, 20 minutes at a premium, right? Which obviously consumers are willing to handle, seen by their success for their business, right? And I think that until consumers have become more resilient and until there's been a rewiring of how we approach solutions in our life, that these companies are going to continue to leverage our laziness for profit, right? Because even Mark Zuckerberg most recently said the new iPhone is going to be glasses. Why? Because it reduces another level of friction. You no longer have to carry your phone. Instead, all of your technology is accessible from your eyes, right? The most immediate form of contact that you have. And so if people don't kind of rebel or kind of choose their own paths, then companies are going to continue to leverage our attention span, our time, and our behavior for more profit in the future. And whether or not that's a good thing is up for people to decide, but personal opinion, I think that's going to be a very difficult road to rewire the future generations as more and more current generations become very complacent.
I think we're already saying that.
Yeah.
It's happening right now. It's a good point about the glasses. Yeah.
Those are some good points too. And you know about Neuralink.
Yeah.
Elon. So imagine taking that a step further and removing that friction, even having those glasses.
Right.
And connection being from the brain to
Just straight to the computer.
Do you want that though?
So
are you comfortable, Gary, with someone being able to get into your interface? I can get into your interface. I can hack into your brain, you know?
Right.
that's a very
Almost like
unsettling.
telepathy.
Yeah, it's a very unsettling idea. Very unsettling. We are, as Americans, the culture is pro privacy, right? And
Mhm.
we're protective of the data that we have on our computers, and
Right.
personal information. So, I mean,
I would probably
think we are.
I would say that Americans want pro privacy, but they don't act pro privacy. It's a difference
Yes.
of wanting versus acting, because as we've seen with Google, Facebook, Amazon, pick your Fortune 500 company, they're using our data publicly,
Yeah.
and everyone knows it. But Americans are okay with it, right? Part of that kind of laziness of the consumer is not just rebelling with your words, but you vote with your dollars, right? That's really what these companies are after. They're after your dollars to create shareholder value. And while I agree that America wants to be pro-privacy, I think it's a long way for policymakers and for the country to shift into a actually pro-privacy legislative behavior. Sorry to cut you off.
No, definitely. No, I actually agree with you. And to your points, especially reiterating what you stated earlier, consumers like convenience. And
Right.
it looks like, although we say with our words, hey, I support privacy, how easy it is for us to say, check, I accept the privacy policy
Oh,
agreement.
yeah.
Right.
And
you read through
yeah.
you just scroll through the terms and conditions and click the box.
Or not even read them sometimes.
Yeah, exactly.
Yeah.
Never
Yeah.
read it.
Mm-hmm.
So,
Yeah, going back to your question about Neuralink, I also think that Neuralink is incredibly dangerous, not just because of the hacking, but I also think it kind of removes your humanity,
Yeah.
right?
That was more my point.
Yeah, I think
Yeah.
more so that part of being humans is having the autonomy to do and make decisions, even if they're not the most efficient,
Right.
right? Because life is it's cliche, but it's a learning experience, right? Everyone's living for the first time, and I think that's really important, that even if you're making inefficient decisions or you're making mistakes,
Yeah.
Why?
That's funny.
right? It's
Yeah.
part of the growth and part of the value that we have as people. Because if everyone acted the same, if everyone grew up on the same curriculum,
Right.
nobody can deviate into creativity, which I think is a really important part of what makes us people.
That's what I'm thinking about when I think of Neuralink. I think of 4 people standing in a circle having an automated conversation. They're all pulling data from this same mind, and it's like, is this real?
Mm-hmm.
Are you actually a human still? I think they had that. There was this guy who had the first Neuralink, and he's saying that his speech is way better. He's able to articulate himself. So I'm imagining people who you're not really even human,
Right.
Part of what's fun in life is, things not being perfect. Do you want everything to be perfect?
Right.
I don't think so.
You're almost more or less regurgitating the thoughts that are fed to you rather than
Yeah.
creating your own thoughts,
Yeah.
right? And it's okay to be wrong. I think that's one of the best things that we can do, because more often than not, our ideas are never complete when they first come out. They're a concept of a concept, and as you continue to develop them is where the real innovation becomes real, or where the real innovation is.
Yeah.
Yeah.
Yeah. I agree.
Do you have thoughts on that, Gary?
I would say mistakes. Being a human is beautiful. And living through pain, living through suffering, living through our mistakes, or making mistakes and living through the suffering of our mistakes is what makes the joys of life that much better. Because if everything was so efficient that no one made any mistakes, what is joy?
Mm-hmm.
How do you define joy? How do you define happiness? If everything was automatic and automated, what makes the human being different than a machine or a robot?
Mm-hmm.
And is this something that, so connecting this to the engineer's dilemma, would you invest in something like this that is definitely going to make life convenient for the consumer, but may have unforeseen consequences? Like, say Neuralink became public today. And Neuralink doesn't do telepathy stuff, right? They do brain to hardware interface at this time, right? So say Neuralink became public today. Would you invest in Neuralink? Why or why not?
I think obviously it's a big moral conflict, but it's really hard to put responsibility on investors because no matter what you do, you almost already have indirect exposure to these kind of quote unquote moral conflicts, right? So when you're investing in Raytheon or you're investing in Lockheed Martin, do I support war? You know, that's kind of what you're asking me, right? Do these companies kind of align with how I see my personal values? And I'm going to say, of course not, right? I don't support war, unnecessary violence, things like that. But it's kind of like a byproduct of investing, right? Is that where your dollars go is not always your responsibility. And I think it's impossible for you to have control over that. For example, if I was an investor in McDonald's or Chipotle and people die of E. coli, am I now morally responsible for these deaths? I think it's very hard to argue that. So I think that if Neuralink, unless it explicitly advertises itself as removing the humanity from others or some type of intellectual hacking, right? I wouldn't be opposed to investing in it, but I would be opposed to investing in that. But if it was a technology that would regain the functionality of people who are disabled, like what it's doing right now, I would invest in that. But if it resulted in some unforeseen event that I cannot predict, that hasn't been explicitly stated, then obviously I would not invest in it.
That's a great answer. How about you, Evan?
I would. Just to go short.
Okay.
I think what you're saying is you would. Mm-hmm. But, you're kind of saying that I think the McDonald's thing, that's kind of like a one-off scenario. Mm-hmm. Like if you're investing in Lockheed Martin, you're signing up for them to make cruise missiles, right? Mm-hmm. But I think I would invest in something like Neuralink just because I know the growth prospects of it. Mm-hmm. Same with ChatGPT. I wish I could have invested in OpenAI. And both of them scare me. But, I think that that's the future and I want to be a part of that, And there is some moral conflict to that. And I'm willing to accept it. Mm-hmm. So,
my only question to you would be then, Raytheon and Lockheed Martin, they're in the S&P 500. You've already invested in them.
That's right. That's what I was going to talk about. That's a good point. Everyone, if you're Vanguard, and
if you're an S&P 500 investor, you're
in there.
Whether you choose to or not, you're contributing, right, quote unquote, if that's your stance, to war and to violence, right? But like I said, I don't think that's necessarily true, right?
Yeah.
Investing in these companies does not mean you either support or against, for whatever reason, these types of acts, but rather you're investing in the company, right? So I can't be responsible for everything that these companies decide to do. I'm merely just a shareholder in what they have stated they want to do.
They're going to do their business without you, right? With or without you.
Exactly.
Sort of deal.
This is such an interesting topic because it touches on governance, right? And also fiduciary duty. Mm-hmm. So as individual investors, you guys have made your positions known. You can do whatever you want as an individual investor. But say you work for a client, you want to get into wealth management, right? And your client says, you know what? I really want to invest in the vices, right? Alcohol, beverage companies, cigarette companies, defense industry, adult industries. Mm-hmm. But you, Daniel, are morally opposed in every way to these things. In fact, you would probably have to, do some kind of penance if you were to invest in them personally.
Right.
So how would you balance that as a wealth manager? The interest of the client versus your deeply held convictions?
Yeah, I think that's a really, really great question, but I want to go back to the client, right? When you're an advisor or wealth manager, really one of the biggest things is client suitability, right? Is this investment suitable for the client? And sometimes when you give a recommendation, the client doesn't necessarily have to agree, right? There's a huge difference in kind of what we discussed in TCM recently between solicited and unsolicited trades, right? So if a client is near retirement and I recommend them to put more of the money in fixed income, that would be a solicited trade, right? Because that's a recommendation that I've provided to them. However, if the client disagrees and they want to put all of their money in what you said, these war stocks, alcohol stocks, drugs, etc., that would be an unsolicited trade. So from a moral perspective, I may disagree, but I have a fiduciary responsibility to serve my clients, and whether or not I want to is not my choice, right? So if a client wanted to invest these things, I would put in the trade ticket, mark it as unsolicited, assuming it did not fit their client suitability and it's a personal investment. That's just something I have to do and I have to live by. If it came down to it to where I believe the client was making so many unsuitable and unsolicited recommendations for their own portfolio, inevitably to where I cannot give them the returns that they expect, I would just have to drop the client. Purely not because of our conflicting moral beliefs, but more so that I cannot accommodate their needs anymore as an advisor, right? I think a really important thing as a future wealth manager is not just appeasing the client, but also understanding that there's certain limitations that you have to set in terms of generating productivity, right? Because when I work with a client and I'm investing all of my time with one single client, I have a whole host of other clients that I am simultaneously not investing my time in, right? So I think it's really important to separate that divide and understand that while I have my own set of beliefs, or I have my own set of responsibilities to both the client and myself, I have other clients that I'm also responsible for.
That's a great answer. Very well spoken. Thank you.
What do you think, Evan? If you were an advisor or if you were in the position where something contradicted your own beliefs like that, how would you respond?
Interesting. I think I would not put myself in that position, and but if I did have to, I would. I care about the needs of my client and stuff, but maybe that's why I don't want to be a wealth manager. I manage my own money. Right. I handle my own business. Mm-hmm. So, yeah.
If I may touch on this a little bit, it's really interesting to see in what point of the relationship these types of conflicts could occur. Mm-hmm. Right? I feel that in VC, these conflicts are less likely to happen because when the VC firm raises a fund, the clients are very clear on the purpose of the fund and its investment thesis. Mm-hmm. The clients are very clear on the VC firm saying, hey, look, this is the stage, this is the industry, this is the type of company, and this is the geography. Mm-hmm. And there are other factors as well. And the potential for conflict may come if the general partner decides to invest in, and this will likely not happen unless it's like a once in a lifetime opportunity deal, like say an OpenAI or something. Right. But it's not likely for the fund manager to deviate from that investment thesis. It's the thesis that guides all investment decisions thereafter. So say I want to invest in companies like Liquid Death, I only want to invest in canned drinks or something to that effect. My companies will be canned drink companies. Mm-hmm. And the conflict might occur if I decide, you know what, I don't want to invest in canned drinks this time. There's an opportunity for OpenAI and I want to invest in OpenAI because it's a once in a lifetime opportunity. Then there might be some conflicts with the LPs. They might mm-hmm. say, hey, this is outside the investment thesis. And there might be some explaining to do, but I don't think that would be as often, those types of conflicts would be as often as the ones that you just described in wealth management.
Definitely. I think you guys play for much bigger stakes in terms of how much money you're managing in a fund versus a singular client. Maybe, I guess a client could be significantly wealthy and hold a lot of your AUM, but typically that's not the case. It's very spread out. So my question to you, going kind of, now that we're kind of leaning more towards governance and advising, what are the type of conflicts that you've seen or heard about at Level Up or with your consulting where you've already made a deal and now the client is seeking advice from you guys, and there's a conflict between what you guys want to do and what they want to do, or what you've recommended and what they actually want to do?
I've actually seen this. That's a great question. I've seen this more in consulting than in venture because I'm not as experienced in venture as I am in the consulting space. Mm-hmm. I have worked with clients that the problem oftentimes isn't that there aren't any ideas, and the conflict arises because the consultant isn't doing the job or isn't researching a problem well enough. The conflicts often occur when there's too many ideas, and there is a challenge in narrowing down an idea into something that is deliverable, something that the client can actually act on. It's very important in consulting, that a statement of work clearly delineates the objectives of the project that we're going to work on and the time frame that we expect to achieve the deliverables. So it's the statement of work is kind of like a fence that keeps us into a specific area that we should look at, and other ideas we have to push back on. Sometimes a client might ask, "Hey, how about this project or this concept that I want to explore, or this market that I want to explore?" And yeah, maybe we can address that in a subsequent project. But for this project right now, we need to focus on the problems that we have identified and the solutions that we have agreed to for this problem. So scope creep is a very real thing in consulting, and I imagine that it might be there might be similar problems like that in wealth management and VC. In VC, I haven't seen it personally, but there may be issues where the VC firm wants additional board seats for a startup that the the founders aren't willing to give up yet, and there might be a conflict that arises there, or maybe there is an investment decision decision made by committee, and committee members might not agree on the investment being made, but there's conflicts arise when there are divergent ideas and divergent goals, and sometimes oftentimes it's not from not having enough ideas, but having too many.
Wow, that was very insightful. I didn't know that. Evan, do you have any thoughts on that?
No. Honestly, it's great to hear you explain things, Gary. I wish I was articulate and could explain it like that. But yeah,
I think you should give yourself more credit because you're very articulate as well.
No,
I agree.
No.
I agree.
I think
you're humble.
Yeah. Well, what can I? No. Trying to think if I had any more questions for you guys. Just like maybe something fun, trying to think. What do you guys think?
I kind of want to talk about the ethics issue that we discussed earlier. So do you guys know about like dual use contracts or dual use products or dual use companies? Companies that
Explain a little more.
Sell to the government and also have the capacity to sell to like a consumer, like Boeing, right?
Okay.
Oh, okay.
Boeing sells to the government and also creates commercial jets.
Uh-huh.
So what do you guys think about an ethical dilemma like this? A company having the ability to make a lightweight material that's stronger than titanium and lighter than titanium that the government would use to put into missiles. But this company can also put it into airplane turbines to make planes lighter. So on one hand, they're selling their goods to, a war machine.
Right.
And on the other hand, they're selling the goods to promote and advance environmentalism. Because if a plane is lighter, it's going to use less gasoline.
Less emissions.
More fuel efficient.
Yeah, more fuel efficient. So what do you guys think about something like that?
I think I think stuff like that is honestly fine, and I think it's more beneficial than it is harmful. If you think about nuclear, right? we kind of signed up for that when we opened that box, right? That's another black box. So while we have all these nuclear warheads that can create total destruction of our world, now we have the most efficient energy source on the planet, right? And whether you like it or not, you get nuclear power in some way, right? That's how we power the grid. So I think if these panels, if Boeing is able to put them in, passenger aircrafts or whatever, so be it. Good. That's kind of like the war innovation is driving. That's like during wartime, manufacturing skyrockets, right? And all these new things come out. So I think it's good overall. If you're able to leverage it for a positive thing, it doesn't all have to be cruise missiles. So that's the good side of it. You made it anyway, right?
Yeah, I kind of agree and I kind of disagree at the same time. I would say that most of the things we invent now can have an alternative use for good and for bad. So it'd be really hard for me to disagree with an investment just because there are some uses that could be bad, right? So if we look at something as popular as AI, right? The good thing about AI is it increases productivity, adds convenience, adds value, adds knowledge that you previously wouldn't have had. It saves time, right? All these great things. But on the other hand, it takes more energy. Maybe it cuts people out of their jobs, right? It reduces some of the roles. Yeah. But would I say AI is a net negative? I don't think I would, right? So if you were to find this miraculous titanium or metal ingredient, I would still be an investor, yes, because I think that every single product will always have a negative use case, and I don't think that's enough to dissuade me from investing into it when there are clearly significant benefits, especially ESG benefits, that outweigh it.
That's a great answer. Yeah, I actually am very much aligned with that. I think that you have to look at it as a whole, right? And the company is not responsible for the way the consumers use their goods. Like you said, anyone can use anything in the world for any bad thing if they wanted to.
Right, yeah.
Right. But that doesn't mean we should ban cell phones. That doesn't mean we shouldn't invest in Apple because some people want to use an iPhone for hacking or whatever else they want to use it for, or component in something that's not good. Right. So how does a company or how does the investor consider that? Or how does a company sell itself to investors where they say, you know what, we're cognizant that some people might use this for this, right? But in general, the benefit is this. What are some of the points that they should talk up?
I think a good example of that is Palantir. I don't know if you guys. So they basically develop AI war solutions, right? They make software that our military uses, and what they're kind of saying is that, hey, we're able to, in a way, make the military and the government more efficient, more proactive. Maybe they are able to find targets in a more streamlined way, as opposed to just we think there's someone in that building, let's blow it up. That's kind of what we've seen in the war, with the war in Iraq and stuff like that. And you're basically, Palantir is offering that to investors. I'm not sure if that's the point you guys were saying, but they're saying, hey, we can make things better potentially, but also we're offering a product that's gonna, potentially hurt people. So.
Yes, I think I agree with that too. I would say, Gary, to answer your question, that I think it's really important for a company to outline what the purpose is. And in the event that someone has some deviant use of the product, that they don't condone it, right? I think that's a really important part of their social responsibility, is that, of course, there's going to be misuses of every product, and even in some cases where it's not foreseen, right? I can't think of an example off the top of my head, but there's definitely been cases where you can't really anticipate humans, kind of how we're talking about earlier.
Yeah.
And so it's very unpredictable that you make what you think is a product that you don't see the angle of how people could use it in a malicious way, but then that ends up happening, I don't know if you can fault the creator for that. I think it's very difficult to predict human behavior, and therefore, as long as the company is not in support of, and it outlines very clearly that this is not the intended use case, I wouldn't see any issues with releasing a product like that.
Okay, so now this kind of ties into my next question, public sentiment.
Mm-hmm.
And the way it will affect the desirability of this company's securities. So, do you guys think that the company putting out a statement condemning such use cases would prevent a flight away from their stock?
When you say a flight, what you mean like the decline in value?
Decline in value. Like say, and we're getting into like behavioral finance.
Mm-hmm.
You know, a company, an article comes out where they highlight how terrorists have used company A's product for A, B, and C, right? Do you think statements would be enough to placate consumers or investors?
I think that consumers are very emotionally reactive, so there could be some short-term headwinds that the company faces, but ultimately, consumers are also very forgiving. There's been a number of companies that have committed a number of grievances, and if I pulled up the S&P 500 right now, they'd be doing just fine. Yeah. So I would say that as long as there are no structural changes in how the business creates money or how the business creates revenue, right, that no, I do not think that the public would be dissuaded from it in terms of investing, because every time a mishap happens or there's some type of real government issue, as long as the fundamentals of the economy remain intact, I think that investors have always been willing to see profit over what they see in the news.
That's a great answer.
Yeah. If you kind of look at Boeing, Boeing is going to be around forever. So there's a certain investor base that's they're never going to sell. Why would they, right? There will always be an endless catalog of people ordering Boeing's planes, no matter how many like strikes happen in their labor union, and Mm-hmm. So I think at some point you don't even have to do press coverage. You don't have to try and sort of say, "Hey, I'm sorry." It's just like
Actually, I'll give you an example right now that I just thought of. So it's been publicly released for however many years now that Apple actually aggregates a lot of their cobalt from the Congo using slave labor. Nike has used child labor. Yeah. I mean, if I took a look at their stock price, right, Nike's not doing so well right now, but I mean, Apple is near all-time highs, right? So again, consumers are aware of the grievances these companies have committed, but how many people do you still see invest in Apple despite knowing that they're using slave labor and they're illegally violating domestic laws, maybe not internationally, but domestic laws, right, for profit? Again, I think consumers are very forgiving, and I think that as conscious as they say they are, like we said earlier, their actions don't always follow.
So what if these ethical violations resulted in severe sanctions from government? Would your answer change?
As an investor, if I think these sanctions can hurt my shareholder value, then yeah. But what Daniel said is actually a really great point. We've known all these things, and those are like two of the best examples. Everyone invests in Apple. That's the biggest component. That's whether you like it or not. The same
the S&P.
The same people who are upset about it's obviously terrible using child labor in these factories overseas. They are investing in it. If they have their 401k, they probably don't even know. But so. And
to my point, kind of what I said earlier, if I told this many people this fact, how many do you think would actually uninvest in Apple, right?
That's true.
I would argue that not many would. They would find some type of moral ring around and say that, well, they're
going to do it anyway.
Different countries, different laws, different regulations, right? Because at the end of the day, that right? I mean, it hurts to say it, but most investors, if it's not in front of them, that's not their primary concern, right?
I think that's more people looking away from it.
Right.
I think, yeah, they don't want to know the truth, you know?
Right.
Yeah.
But again, for your original questions, government sanctions. Sorry, what was the original question?
If these ethical violations resulted in severe legal sanctions, large fines, breakups of divisions of the company, bans.
If that were to happen, yes, I think it would in fact greatly affect investor sentiment. But I also think that it most likely wouldn't happen. I think that corporate culture dominates a lot of American politics, and that these companies have done a really great job at creating these lobbyists that make sure that the fact that their business, no matter what crimes they commit, will always remain intact no matter what. And that's the unfortunate truth of how the political structure and how the corporate structure is made now. There's a lot of influence to where dollars mean a lot more than votes, right? So I think it's really important that, if government sanctions were to happen, and that's the only way these companies could be taken down, it'd be very difficult to do with the current buying power that these companies have.
That's a great answer. And, to your point earlier about consumers valuing convenience above all else, and, if consumers are willing to continue buying iPhones, and other products, then, what is the likelihood of, the company's securities devaluing or they're losing revenue over their ethical lapses? Exactly. Does this make consumers complicit in corporate action?
In a sense, yes, but I'm just going to say no. There's, they're not saying, they don't break, when you go to the Apple store and buy a phone potentially, they don't break down hey, here's our cost structure, here's how we did it, right? They're not going to tell you that. So I would say they're not complicit with it, yeah.
I would say yes and no. I think it's really hard to, again, kind of blame my dollars for someone else's actions. It's a really difficult thing to get my head around, to say that I'm actively contributing to slavery and other forms of crimes, because that's really not my intention, right? My intention is just to get a return on my investment. Not to say that I don't care how that happens, but to say that I have direct contributions to it would feel a little disingenuous. I would say indirectly, yes, but not the purpose of my investment. What would you say, Gary?
That's also a great question. I think when I was younger, I would have said yes. I was very idealistic as a young man. There were certain things I did not buy because of one reason or another. And today, with a little bit of experience, I think I align with you. Just because I buy a product doesn't mean I actively condone this activity that's happening in this part of the world. And I imagine that there's also several degrees of removed from those actions. I don't know if that absolves me completely, but I would also say, it's the world's not black and white. Right. Just because I buy an iPhone doesn't mean I'm evil. Just because I, do
wear a Nike
shirt doesn't mean I condone slavery, right? It's a matter of saying, yeah, I acknowledge it happens, not, denying that certain things happen.
Correct.
And also recognizing that, there's only so many options that we have in this world, right? So
I also think a part of it is that American society, or more so the capitalistic structure, you're almost forced to invest. So you're almost, right? Because if I had an income, even on a higher end of $100,000 a year, and I lived till 65 or 85, right? The average, lifespan, right? The money I make in my career would not be enough to ever retire. I'd have to work infinitely. And the only way to make it out of there is to invest, right? And so now you're asking, well, how can I make inflation-adjusted returns with ESG investing? It's going to be really, really hard, because I'm sure it's possible, but the amount of time and resources that it would take and the management fee that I'd have to pay for that type of investing and caution would be ridiculous, right? To where I'd probably be losing money in terms of not just investing in the S&P 500, right? So when we really talk about ESG investing and people investing in general as a whole, the way the system is structured now, it's impossible to reach that level without this quote unquote, indirect exposure to these crimes, right? So I think that's also a problem, is that whether or not you like it or not, if you want to be able to retire and, enjoy the fruits of your labor, you kind of have to participate in a way, right?
That's great. It's going to be very hard to get away from it. Yeah. Go ahead. Sorry.
I was going to ask you if you had any thoughts on that, Evan.
Yeah, I think if you're looking after yourself and you're saying, all right, I need to supplement my income somehow, and if I want to retire, you have to invest in certain things. I'm sure there is a great ESG fund out there that maybe doesn't have like a crazy 3% management fee, but I don't know. It's a lot. There's a lot of stuff that's involved, because the line gets drawn just so many times to where you have to make pivots, and you have to can you effectively capture the returns of a company if you're constantly pivoting between all these different,
right. I think it's also, you bring up a really good point. What is the line? Like, let's say, for example, there's this perfect company. They do all these things right. They ethically source everything, but then they don't pay their workers enough. They pay them, minimum wage or below, whatever is necessary for cost of living in that area. Is that an ethical line for you now? And if a company in an ESG fund commits a crime, accidentally, intentionally, whatever you may have it, does that company now get removed from the fund, and to what extent, right? If there's a death in a factory, intentional or not, where do you draw that line, right? I think it's a very hard thing to manage, and also a hard thing to judge from a moral perspective, where these lines come from and how deep do they go. So.
Yeah.
Do you have any thoughts on that, Gary?
I think, well, from my background, I do value ESG. At the same time, I also recognize that, one, there's a fiduciary duty, and two, if a company or if a fund doesn't make decent returns, it's probably not going to last for very long.
Right.
Right. So I think ultimately the fund has to balance its interests, but those interests shouldn't overtake its mission of generating a healthy risk-adjusted return for its client.
Above a benchmark, right?
Yeah, above a benchmark.
Right. That's a very good point.
Yeah, and if your benchmark is something that's not following those guidelines, you're out of luck. So,
yeah, I think it might be different between the public and the private investment spaces, because in like a VC space, I almost want to say that it's easier to fulfill an ESG mission, because I can invest in early stage companies that are focused on sustainability, that are solving a real world problem, and I fulfill my ESG mission while preserving my potential, my capability of making an outsized return from that company. And then also the liquidity is locked up. So once I've made that investment, there's not too much active management as far as investing and uninvesting goes. Unlike with public securities. And also the governance aspect of VC is a little bit different. There's a little bit more of a hands-on approach to it, where the VC can guide company decisions in a particular area. So it's definitely a different world.
Yeah, I think you raised a really great point. I also think a lot of it plays into, correct me if I'm wrong, the size, right? There's such a smaller cast of people, so that in general that most of the members, of the management are being taken care of, right? Especially if it's a sustainability fund. So there's less responsibility, whereas if you have a bigger conglomerate, there's, at a certain point, tens of thousands of people you're watching over. it's very hard to imagine that all 10,000 are being treated with the same amount of care that a handful of people are, right?
Yes, I see the point where you're going. Yes, so with early stage companies, you have the founder, a couple managers, and then a handful of employees. So the human risk is definitely lower than in a corporation where you have thousands of people, and you can't because humans are very complex. We're complex people, right?
Right.
The only thing more complex than one human being is two human beings, right?
Yeah,
More than one human beings, and any one of those employees could make a decision that could send the company on the wrong path or cause some type of external consequences. So with managing a company or investing in a company with a private company with a lower number of employees, it's a little less risky as far as human factors go. And there's more diligence done on the people who are being invested in. So
That was a great point. Evan, do you have anything to add?
No, not really. You guys got it.
Awesome.
All right, guys. That has been Top Down with TCM. It was beautiful talking to you guys. Gary, Daniel, you guys are awesome.
Great.
Any closing thoughts before we go?
Stay blessed.
Stay blessed.
Stay blessed. Thank people, be appreciative, be your best self. What do you think, Gary? You're always motivating me in some way.
Oh,
you're always
I
doing
appreciate
something.
that. You're very encouraging, and I think that's what my next statement will be: is to be of value. And you're of value. You're encouraging. You're positive. So be of value. Make an impact. Don't just extract value, but contribute value.
Yeah, I think it's a great point. I would say just start sooner. Just whatever you're trying to do, there's no better time than right now to do it.
Yeah, I agree. There's a lot there. I agree. Why not, right?
Exactly. Why not?
There's a time value of money, and there's also a time value of life.
Time value of life.
Very true.
Yeah.
Very true.
Yeah.
All right, fellas.
All right, guys. Great
All right,
talking.
great talk.
Yeah.